Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in, take a look, see what's going on today. If you want to follow me, it's at Finance, and if you want to join our community, finding-value.com, I dive deep into all of these topic sectors, looking for investment opportunities, sharing those opportunities with everybody in the community. Yes, I look for dividend payers. Yes, I look for speculative companies with lots of upside potential across all of them. That's the goal, to maximize asymmetric opportunities. If that's something you want to be exposed to, and if you want to hang around people who also like to talk about the stock market and macro and all sorts of stuff, definitely sign up. We do have a Discord as well. Special as a coupon code if you'd like to join. You get 50% off the first month on the monthly membership and a larger discount, a $100 discount on the yearly membership. So we got Gary Baum here. He says, or Bohm, he says, buying silver today is akin to being given a time machine to purchase gold in early 2024 before it decisively broke the $2,000 an ounce barrier and never looked back. The setup is similar: a long period of consolidation, widespread investor apathy, and a powerful fundamental story that the market is ignoring. Only silver's breakout is longer in the making, much, much longer. The higher the base, or the longer the base, the higher in space. So we've got silver. It's got this gigantic monster pattern. I call it monster patterns change lives. And what that is the higher the base, the higher in space. The monster pattern is a big pattern that breaks out and gives you life-changing gains. Silver is there, yes. Now, this pattern is massive. It started in 1980, and we've got that big cup and handle. You've seen it a billion times. I don't think that when you break the $50 an ounce area, that we're going to go to like $100 an ounce. When you get a base that big with that much consolidation and power, me personally, I don't think it's going to stop at $100 an ounce. I think we're going to blow way up there. Now, that doesn't mean we're going to do it all in one shot. So when I get bullish on something, this is what all retail investors do. They think that it's going to go straight up with no pullbacks. Show me a market that does that, where it just goes straight up, like straight vertical. You're always going to get some consolidation, some pullback, some whatever it is. It's always going to get the retail herd shook up. We may even hit 50, do a sharp pullback, and then a big move higher, just to shake and wash people out, because the bull doesn't like everybody making easy money. It seems like that's the case. So I'm in the camp, yep, it's going to be a big breakout. Yep, it's going to take time. It's not going to be vertical to $1,000 an ounce or $500 an ounce in like 1 year. I just don't, it could happen. I'm not saying it can't, but I just don't think it's going to go that fast. My opinion there. Warren Buffett talking to Peter Lynch. He said, my biggest mistake was that I always sold stocks way too early. Okay, so he said yesterday with the update there about people selling early in big bull markets and very few people taking advantage of the big trend. They were reading the tape when they should have been sizing up the trend. Peter Lynch, when he wrote his book, said his biggest mistake was that I always sold stocks way too early. In fact, I got a call from Warren Buffett in 1989. My daughter picks up the phone and says, it's Mr. Buffett on the line. And I pick up the phone and I hear, this is Warren Buffett from Omaha, Nebraska. You know, he talks so fast. And I love your book, One Up on Wall Street. And I want to use a line from it in my year-end report. I have to have it. Can I please use it? I said, sure. What's the line? He says, selling your winners and holding your losers is like cutting the flowers and watering the weeds. That one line he picked up my whole book has been my greatest mistake. His greatest mistake is, again, selling too early. Now, I'm not stating that we can hold a speculative silver company for the rest of our lives. I understand that, guys. I'm not naive to that. But I do think that if you were to read a lot of these books, a lot of the biggest mistakes that people make that even you guys know, Warren Buffett as well will say this, is that they didn't hold stocks long enough. Now, I understand that they like businesses that kind of work in any market condition. The Coca-Colas, the Cease candies, the Milky Way, whatever, what Snickers bars, whatever it is, right? I understand that. And they like those a whole bunch. And really, that's just holding for the rest of your life. You buy it when it's early, early in your life, and then hold it for the rest of your life. But I do think we could apply some of this to our own holdings. A lot of people do not want to hold anything. They've got a trader mindset. A trader mindset is they want to be in cash as quickly as possible. They want to dip their toes in the water and then get right back out. An investor mindset is the exact opposite. You don't want to hold cash. You want to go and invest that cash into companies, and you feel safer and better when you're invested into the companies. Two vastly different mindsets. An investor mindset is about optimism. Oh, things will work out. It's going to be great. Can't wait to get in that stock and hold on to it. The trader mindset is a little bit different. They want to grab the profit, take it, grab it as soon as they can, and get me the heck out because they think something bad will happen. The next big sell-off, the next big recession. It's a totally different mindset. I'm in the mindset of the optimistic long-term view where I don't want to hold cash and I want to get in the companies. That's my mindset. I don't have a trader's mindset. I never had that. But some other people do. Some people will say, do whatever works best. I think that's just bullcrap. I think you should do whatever strategy works best, not trying to mold the market and strategies 100% to you. I mean, you got to meet in the middle. You got to pick a good strategy and mold yourself and learn how to work with a strategy that really works, is my opinion there. You can't make and form everything to the person's personality trait or traits. Coming down, we've got repeating this Druck quote every morning to myself like some Zen mantra so I don't do something stupid. So this is coming from Stanley Druckenmiller, another top investor. He says, so like around March, I could feel it coming. I had to play. I couldn't help myself. And 3 times the same week, I pick up a don't do it. Don't do it. Anyway, I pick up the phone finally. I think I missed the top by an hour. I bought $6 billion worth of tech stocks. And in 6 weeks, I had left Soros and I with a loss of $3 billion in that one play. You asked me what I learned. I didn't learn anything. I already knew that I wasn't supposed to do that. I was just an emotional basket case and couldn't help myself. So maybe I learned not to do it again, but I already knew that. So what did he do? Other people were making money in the stock market, the tech boom, back in 2000. He saw it, got emotional, and bought the top of the tech market and lost $3 billion in that one play. What did he learn from that? Absolutely nothing. He knew that he was already supposed to not be there. Now, here's a couple of things I want to talk about that pertain to this. So some people will say, let's just give it a hypothetical. All right, you're in a stock. Let's say it's a copper stock. All right, we're just going to make it up. We're in a copper stock. It's completely underpriced. It is kind of coming along the bottom and coming out of a base. Now, sometimes in the beginning, they don't move very quickly. So you're in this base, You break out, you get a retest, you get all these things, and it takes its time. Maybe it takes 6 months or a couple years to get out of the base and get through that consolidation on top of the base. At the same time, over in tech stock land, things are going vertical because it's at the end of their bull market. And sometimes at the end, they go vertical. So you've got the bottom of the commodity groups and you've got the top of the technology sector. Now, somebody's going to go along and say, hey, look, you're underperforming these tech stocks. Why didn't you buy tech stocks? And your answer should be, I don't want to be there because they are overvalued. And I don't want to subject my portfolio to that type of risk. So I buy the undervalued stuff with good technical bottoming patterns and play that. But at some point, you're underperforming the other sector. Now, here's the thing that people should know. You don't have to outperform the market 100% of the time. There's going to be times where you massively outperform it, and then there could be counter trend moves where other parts of the sector outperform you for periods of time. That should be absolutely fine. You don't want to be running around chasing price performance. Why? Because then you subject yourself to this right here that Stanley Druckenmiller subjected himself to. He knew he shouldn't have done it. He became an emotional basket case. He chased he chased the stocks. He chased into that FOMO, the fear of missing out. He got absolutely whooped. And this can happen to everyone. Now, retail investors do this all the time. That's their entire investment career, is running around looking at 10-year performance charts and chasing price performance and swapping from one asset class to another just because it's done well the past 3 or 5 or 10 years. That doesn't mean that the cycle is going to continue to go up. You want to buy what's undervalued, and then money just goes around and chases price performance. So if you buy what's undervalued, money starts flowing in, it starts to outperform, and then all the retail people just chase price performance. So they all pile in. That's when you get out. And how do you protect yourself? And how do you stay in cycle? It's whatever's of good value. 1980s, early 80s, what was good value was tech stocks and the S&P 500. It was financial assets. And you could even say the bond market. Today, it's the exact opposite. It is commodities and precious metals, and the financial assets are expensive. You want to avoid what's overvalued and overpriced. You want to avoid what happened to Stanley Druckenmiller. Even if the stock market goes up, there's going to be a strong pull of FOMO into those sectors that are going up. Katusa says the gold price is wrong. Gold is actually cheap relative to the global currency fiat money supply. And the setup for much higher prices is staring us in the face. At $3,600 an ounce, everyone knows that gold is at a nominal all-time high. But relative to the M2 money supply, it's well below historical peaks. This suggests significant upside potential if the market catches up to monetary expansion. If gold matches this 2011 money supply ratio, you're looking at about $4,400 per ounce. If gold matches the 1980s ratio, it's about almost $10,000 an ounce, and that keeps going higher as the M2 money supply keeps getting expanded. Now, some people will say, well, these were peaks. These were peaks. These were bubbles. It's not a bubble. It's just part of the cycle. Things get overvalued. They call it a bubble. And then it gets undervalued over time. Undervaluation in like 2018 in here. Undervaluation in 2000. And then it runs up, consolidates and runs up again. And really all this is, guys, it's money sloshing around the system. It goes from one sector to another sector to another sector. That's all it is. So some money is in the system. It's sloshing around from sector to sector. blowing up one sector and depressing another sector. So when money flows from sector one to sector one goes down, sector two goes up. Now, if you've got buttloads of money entering the system through M2 money supply, it is possible that all asset classes or sectors go up together because there's just so much money coming into the system. That is possible. But we want to be in the ones that outperform, and we want to be able to at least get close to getting the right market conditions because the market conditions determine how money flows in the system. M2 adjusted silver, since we're on the M2 adjusted spot, a long-term perspective, and look how low we are in silver. It is turning higher. It looks really good. Now, if we were to go all the way up to this top here in 1980, oh my goodness. Now, are we going to do that? I don't know. But I can tell you down here, like in 2000, absolute low point, and here in 2023 and 2020, oh my goodness, this was cheap. And we're just starting to turn up and outperform. Now, the market condition that we are in, gold and silver go up against the M2 money supply. Gold and silver are preferred and money flows into it. That's a part of the market condition. And this going up tells us what condition we are in. So if it goes up, we're in more of a inflationary, increasing interest rate environment, perhaps. And maybe we're going to get a lot of money rotating into commodities too. So those are the charts we want to see bottoming and starting to go into favor. Barbell Financial. I'm trying to figure out the best place to move to raise a family. Here's the criteria: safety, schools, weather, hospitals, things to do, cost of living. What would be your top pick? I mean, I chose the state of Colorado. I think that's a good pick. But there's a lot of states that are pretty good that can meet this. And there are cities where you have good parts of cities and you've got bad parts of cities. So I don't know. The one thing that I would say, or what I would try to do, and this is just me, and I know it sounds kind of bad, but I would choose an area that isn't the cheapest area. I would choose an area that is more expensive. And a lot of the times, if it's a little bit on the more expensive side, you might get a little bit more white collar type people, and they want to send their kids to college, and then your kids will be subjected to those kids, their kids, and if they're all going to college, it's a good thing, right? I'm not saying that your kids have to go to college. I'm just saying it's good to have kids that have plans. Put it that way. Stefano says GDX, GDXJ, SILJ, gold, silver. The patterns clearly suggest that it's the junior silver stocks that still have the most upside potential. Those who missed the cup and handle breakouts on the gold stocks already lost a fantastic rally. Those who ignored the triple bottom on the silver stocks are missing another great move. And those who don't see that the juniors are still lagging will miss out on a fantastic rally ahead. So this is GDX at the top here, breaking out. GDXJ, that's moving. And then SIL is already moving. SILJ, which isn't on here, it's broken out, but it hasn't moved as much. There are some speculative junior companies that are still really, really low and are great entry points. But there are fewer and fewer of them. So as this bull market progresses, as we keep going up and up and up, your risk reward is changing. It's dynamic. So a lot of people will say, Andy, what's your portfolio allocation to this sector, right? Let's just say for silver sector, right? Whatever percentage it is. I'll just make up a number. Let's say it's like 15%, right? So let's say I have a 15% allocation to silver. That doesn't mean that my allocation today is what I would allocate immediately right now, because your risk is determined by your entry point. Your entry point here is a lot less risky than the entry point up here. So your portfolio allocation sizes, although maybe I only put 10% here and it's 15 up here or more, your risk is determined by when you enter something and when you purchased it. And your percent allocation isn't a fixed amount. It moves all over the place. In fact, it really shouldn't be a big deal of what it is. Like, you shouldn't make that a big deal. Your risk and the valuation that an opportunity has should determine your portfolio allocation, your position sizing. It's a function of risk and a function of the opportunity that that company is giving you. So when I look at things and I look at the world, I don't look at things like, oh, I need 50% here and 20% here and 20% here. I look at it like, well, where are the best opportunities with the least amount of risk? I evaluate it, and then I say, well, how much should I allocate to it? And when I create a portfolio, and let's just make it up, in 2020, my portfolio allocation may be completely different than in 2023, than it is in 2025. And I might be buying completely different companies in each of those years based off of the risk and the rewards that I see in the sector. And then, it's important that you're viewing the risks and the rewards appropriately. You're not fictitiously assigning bogus crap to it. Like, you need to see the market accurately. You need to accurately figure out how to assess it and then make a determination off of good judgment. Here's Grady. He says, been saying good times for silver miners are coming, and they've been moving hugely. Had another big day yesterday. Posted this chart 18 months ago in linked post below saying it was time to buy the large silver miners. It was. This is the kind of guidance you need to make big money in a bull market. Following the right people is absolutely vital. So SILJ divided by SLV, the slingshot move from around the arc apex. So also this move will be epic. Probable end around the blue and round apex move coming. My own term and pattern, it is now happening. Very probable false breakdown or breakout. It says here we bought the large silver miners heavily at the service there. What we've been doing, or have done, I should say, there were companies that were on our watch list. They were silver producers, silver speculative junior companies, gold producers, gold speculative companies. Now, I didn't go too big into the big companies. I like kind of the mid cap, small cap guys and some of the junior companies. So we were picking off bottoms since 2022, 2023, and 2024. We've been just picking off bottoms all through here based off of the charts. We had to sit in them a little bit, and now some of those are up massively, many hundreds of percents. Now, some people say it's easier to hold on to a stock when you're up hundreds of percents. I disagree. I think it's all the same. It's all the same. It's just as easy or hard in the beginning, and it's just as easy or hard as it goes up. Because the decisions that you make, if it goes way up, are pretty vital. If you put in some money in the beginning, the dollar value that it moves up and down is a lot less than the dollar value when it moves later on if you're sitting on a 10-bagger. If you're sitting on a 10-bagger, you might be moving up and down your pullbacks more than your original purchase cost, more than your cost basis. There are times where my cost basis was $1.50 in a stock, and I was getting daily moves larger than $1.50 in the stock later on, 3, 4, 5 years later. So each day it was moving more than my entire cost basis in the stock when I purchased it. Macro Liquidity by Sunil Reddy Says, tweet one, the financial system is already breaking apart in slow motion. Gold is rising against the money supply. Housing is cracking against gold. Stocks are diverging. Silver is confirming. These signals don't resolve quietly. They resolve in exponential repricing. And he's got these charts down here. Well, here's the thing. When the housing market is in an expansion phase where the economy is strong and interest rates are going up, now I'm not saying that the economy is strong. We may be in a weird debt crisis problem. But housing doesn't outperform gold in a housing boom. Gold outperforms it. And gold also rises against the money supply in that same scenario. So is this a normal market cycle move or is something different? I'm in the camp that I can't tell the difference. I think it's a normal cycle move, and I think people just aren't used to seeing this. This move is not like the year 2000. 2000, that was a bottom. This is a bottom move. This coming up is going to be like, it's going to be a different move here, guys. And the reason is because interest rates were still in a downtrend in 2000 to 2011 and behind that and beyond that. We were in a downtrend. Now we're in an uptrend. And people haven't figured that out yet. Things have shifted underneath our feet and they haven't figured it out yet. But they will. It'll just take a little bit of time. Been a while since I looked at this one. So this is gold, silver, palladium, platinum, all in a row. So gold, silver, palladium's in the middle, and platinum's on the bottom. And then you can see gold's broken out. That's ripping. Silver's about to rip here any second, and then palladium's turning up, and platinum is broken out of its squeeze here. This was back in the 1970s. You can see in the 70s here that all of these went up, even in the 70s here. Gold did. You can see palladium did. You can see platinum also, or palladium here. Sorry, this is silver here, palladium here, and then you can see the big move in platinum. And now we're all just starting to rip higher here coming up. They all look good. This is silver USD. Daily long-term momentum is breaking in silver. What does that mean? It means that things can speed up. This is momentum. So when people are saying, oh, we're going to get this big pullback, that's momentum here, guys. If momentum breaks out, that means things are going to accelerate. That means that all the people who are telling you that this RSI is overpriced, blah, 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 it doesn't matter what they say. They're probably wrong. They could be wrong. So when this momentum breaks, time's up. It's go time. We're going to see big, 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 big moves. Now, I'm positioned for this. I'm not selling out. We're like right at the breakout here. And this is when momentum could pick up. So I'm sticking with it. But that's all I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. Specials, that coupon code. And that's all I've got. So we'll catch you next time, guys. See ya.